Invest Smart, Live Free. A Beginner's Blueprint to Financial Freedom. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Imagine waking up every day without the stress of wondering how you'll cover the bills, save for retirement, or afford the lifestyle you've always dreamed of. What would it feel like to live free from financial worries, with the confidence that your money is working for you, even when you're not working? That's the promise of financial freedom, and the path to that freedom starts with one simple truth: smart investing is the key to living the life you want. But here's the problem. For many people, the world of investing feels intimidating, overwhelming, and out of reach. Maybe you've thought about investing but didn't know where to begin. Maybe you've assumed that it's only for the wealthy or those who have years of financial expertise. Or maybe you've already started but feel lost in the sea of stock market jargon, unsure if you're making the right moves. If any of that sounds familiar, you're in the right place. This book, Invest Smart, Live Free. A Beginner's Blueprint to Financial Freedom, is designed to simplify the often complex world of investing and give you a clear, actionable roadmap to take control of your financial future. It's not just about making money, it's about creating a life where money is no longer a constant source of stress. It's about building wealth in a way that aligns with your personal goals and values, no matter where you're starting from. Why investing matters, and why it's easier than you think. Most people focus on earning money from their jobs, but the reality is that earning alone won't make you wealthy. To build lasting financial security, you need to make your money grow, and that's where investing comes in. When you invest, you're putting your money to work, allowing it to multiply over time. With the right strategy, even small, consistent investments can turn into significant wealth thanks to the power of compounding. But here's the thing. You don't need to be an expert to get started. In fact, you don't need a finance degree, a high-paying job, or thousands of dollars sitting in the bank. What you do need is a solid understanding of how investing works and a step-by-step plan to get started, and that's exactly what this book will provide. This book is your blueprint for taking the mystery out of investing and transforming it into a simple, manageable process that you can integrate into your daily life. You'll go from feeling uncertain and overwhelmed to confident and empowered to grow your wealth and create the financial freedom you deserve. Financial freedom isn't just about having more money, it's about having more control. It's about creating choices, whether that's choosing to retire early, take a dream vacation, or pursue a passion project without worrying about the paycheck. It's about living life on your own terms. And the best part: you don't have to wait decades to start feeling the impact of smart investing. The steps you take today can begin to change your financial outlook immediately. Whether you're 25 or 55, this journey is for you, and the best time to start is now. We've noticed that 67% of you watching our videos haven't subscribed to the channel yet. Help us grow by hitting the subscribe button and giving this video a thumbs up. Thank you for inspiring us to keep creating content for you. I would love to hear your thoughts. How did this book resonate with you, and what insights or questions did it inspire? Chapter 1. Why investing is the key to financial freedom. Many people dream of financial freedom, the ability to live life on their own terms, free from financial stress, and able to make choices based on their desires, not their bank account. What if I told you that one of the most powerful ways to achieve that dream is by learning how to invest? Investing can seem complex or intimidating, but it doesn't have to be. By the end of this chapter, you'll begin to see how investing can be the engine that powers your journey to financial independence, and most importantly, that you can start investing, regardless of your current financial situation or experience level. What is financial freedom? Financial freedom means having enough income and wealth to cover your living expenses without relying on a traditional job. It allows you to retire early, pursue your passions, or simply have more control over your life. This freedom often comes through building multiple streams of income, with investing being a key component. But before we dive deeper into investing, let's break down how financial freedom works. Here's the basic idea. Financial freedom is achieved when your money works for you. This means that instead of just trading your time for money working a job, you're earning money passively from investments. Imagine getting paid while you sleep. That's the power of investing. Passive income. Income you receive from sources like investments, real estate, or a business you own, without requiring constant active involvement. Active income. The money you earn from working a job or running a business. For most people, Financial freedom comes when their passive income exceeds their living expenses. In other words, you're no longer dependent on your job for survival. One of the biggest myths about investing is that you need to be wealthy to get started. Many people hold back from investing because they believe they don't have enough money or that investing is only for the rich. This couldn't be further from the truth. Here's the reality. The earlier you start, the more time your money has to grow. Even small amounts can grow into significant sums if you invest wisely and consistently. It's not about how much you have right now, it's about getting started and staying committed. By breaking free from the idea that investing is only for people with large amounts of money, you open the door to financial freedom, no matter your starting point. In fact, some of the most successful investors started small. So what exactly is investing? At its core, investing is the act of putting your money into something like stocks, bonds, or real estate, with the expectation that it will grow over time. In other words, you're using your money to make more money. There are many different ways to invest, but the principle remains the same. You're buying an asset, holding it, and hoping its value increases over time. When it does, you can sell it for a profit or continue to hold it to earn income like dividends from stocks or rent from real estate. Let's look at two simple examples of investing. 1. Stocks. You buy shares of a company, hoping the value of those shares will increase. If the company grows and becomes more valuable, so do your shares. Eventually, you can sell them for more than you paid. 2. Bonds. Think of bonds as loans you give to companies or governments. In return, they promise to pay you interest over time. Once the bond matures, they pay you back the full amount you lent them, plus the interest. Why investing is essential for financial freedom. Now that you have a basic understanding of investing, let's talk about why it's so important. Simply put, investing is the most reliable way to build wealth over time. When you invest, your money has the potential to grow exponentially, especially if you take advantage of compound interest. Compound interest is one of the most powerful forces in investing. It's when your returns start to generate their own returns. Over time, this creates a snowball effect, allowing your wealth to grow faster and faster. Here's a quick example. Imagine you invest $1,000 at a 7% annual return. After 1 year, you'll have $1,070. But in the second year, you're earning 7% on $1,070, not just the original $1,000. Each year, your returns grow on the larger amount. Taking your first steps. Mindset shift. At this point, you might be thinking, this sounds great, but I still feel overwhelmed. That's normal. Investing is a journey, not a race. It requires a shift in mindset, one where you stop seeing money as something to be spent immediately and start seeing it as a tool for building future freedom. Here's where the transformation begins. Start thinking like an investor, even if you've never bought a single stock. The first step is deciding that you want to take control of your financial future. By doing this, you've already begun to shift your mindset from spender to investor. Before moving on, let's recap what you've learned so far. Investing is the key to financial freedom. It allows you to generate passive income, grow your wealth, and reduce your dependence on active income. You don't need a lot of money to start. Even small amounts invested wisely can grow significantly over time. The earlier you start, the better. Compound interest rewards time, so don't wait. Mindset is critical. Becoming an investor is about shifting your thinking toward the long-term benefits of financial independence. You might feel like you're standing at the base of a mountain, but remember, every great journey begins with a single step. Financial independence isn't achieved overnight, but with commitment and consistency, you'll get there. So, what's your first step? Even if it's learning more or setting aside a small amount to invest, you're already on the path to financial freedom. Chapter 2. The Investment Basics: Stocks, Bonds, and Mutual Funds. When you hear people talk about investing, they often mention terms like stocks, bonds, and mutual funds. For a beginner, these words can sound like another language, and it's easy to feel intimidated. But here's the good news: once you break it down, it's not as complicated as it seems. In this chapter, we're going to simplify the core types of investments. By the end, you'll have a solid understanding of these financial building blocks and feel confident about choosing the right investment vehicles for your financial goals. What are stocks? A stock represents ownership in a company. When you buy a stock, you're buying a tiny piece of that company. Think of it as owning a small share of a business. This gives you the right to a portion of the company's profits, and as the company grows, the value of your stock may increase. Here's a simple way to think about it. Imagine you and your friends open a lemonade stand. If you each put in some money to buy lemons, sugar, and cups, you all own part of the lemonade stand. If it becomes popular and makes a lot of money, your share of that stand, your stock, becomes more valuable. Key characteristics of stocks. Growth potential. Stocks can grow in value over time. If the company you invest in performs well, your investment can increase significantly. Stock prices can fluctuate, sometimes dramatically, in the short term. This means stocks carry more risk compared to other investments like bonds. Dividends. Some companies pay dividends, which are regular payments to shareholders from the company's profits. What are bonds? Bonds are a bit different from stocks. When you buy a bond, you're essentially loaning money to a government or company, and in return, they agree to pay you interest over time. After a set period called the bond's maturity, they return the money you lent them. Think of it like this. Imagine your friend needs to borrow $100 to start a small business. They agree to pay you back the $100 in 2 years, plus interest. That's essentially how bonds work. You're the lender, and the company or government is the borrower. Key characteristics of bonds. Lower risk. Bonds are typically considered safer than stocks because they offer regular interest payments and return the initial investment unless the borrower defaults. Fixed income. Bonds provide a steady stream of income in the form of interest payments, which can be appealing if you're looking for stability. Maturity date. Bonds have a set date when the borrower must return your money. Short-term bonds may last a few months, while long-term bonds can last 10 years or more. What are mutual funds? A mutual fund pools money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. This means when you invest in a mutual fund, you're essentially spreading your money across many different investments, lowering your overall risk. Let's use an example. Imagine you have $100 to invest, but buying a single stock of a major company costs $500. Instead of buying just one stock, you can invest that $100 into a mutual fund, which spreads your money across many stocks and bonds. This reduces your risk and gives you a small piece of a wide variety of investments. Key characteristics of mutual funds. Diversification. Mutual funds spread your money across different investments, reducing the risk of losing money on any one investment. Mutual funds are managed by professional fund managers who make the investment decisions, which can be helpful if you're just starting out. Mutual funds often come with management fees, so it's important to understand the costs before investing. Why diversification matters. Don't put all your eggs in one basket. One of the key benefits of mutual funds is diversification, a strategy every investor should understand. Diversification means spreading your investments across different types of assets like stocks, bonds, and other investments to reduce risk. If one part of your portfolio loses value, other parts may balance out the loss. It's like making a delicious smoothie. You wouldn't only use bananas. You'd throw in some strawberries, maybe some spinach, and a little protein powder. That way, if the strawberries aren't ripe, the other ingredients still make your smoothie taste great. Diversification in investing works the same way. If one investment doesn't do well, the others can help protect your overall portfolio. Now that you understand the basics of stocks, bonds, and mutual funds, you might be wondering which one is right for you. The truth is, there's no one-size-fits-all answer. The best investment for you depends on your financial goals, how much risk you're comfortable with, and how long you plan to invest. Here are some things to consider. If you're willing to take more risk for potentially higher returns, stocks might be a good option, especially if you're investing for the long term. If you prefer safety and steady income, bonds might be a better fit, especially if you're nearing retirement or want less volatility in your portfolio. If you want instant diversification and professional management, mutual funds can be a great way to get started, especially if you don't have the time or expertise to pick individual stocks and bonds. Remember, you don't have to choose just one. Many investors use a mix of stocks, bonds, and mutual funds to create a balanced portfolio. The key is to find a balance that fits your financial goals and comfort with risk. Common mistakes to avoid when investing. It's easy to get caught up in the excitement of investing, but beginners often make a few common mistakes. Let's talk about how to avoid them. 1. Trying to time the market. Many new investors make the mistake of trying to buy stocks when prices are low and sell when prices are high. This sounds great in theory, but in practice it's nearly impossible to do consistently. Instead, focus on long-term investing, where time in the market matters more than trying to predict short-term moves. Tip: a good way to avoid this trap is by using a strategy called dollar cost averaging, where you invest a fixed amount at regular intervals. This helps you avoid emotional decisions based on market fluctuations. 2. Not diversifying enough. We've already talked about the importance of diversification, but it can't be stressed enough. Putting all your money into one stock or asset class is risky. Spread your investments across different areas to reduce the impact of any single loss. Consider starting with a diversified mutual fund or an exchange-traded fund ETF, which can give you exposure to a wide range of stocks or bonds with a single investment. 3. Getting scared by market volatility. The stock market can be a roller coaster. Prices go up and prices go down, it's all part of the process. The key is not to panic during the downturns. Tip: stay focused on your long-term goals and remember that market volatility is normal. The market has historically recovered from downturns over time. Let's review the essential concepts from this chapter. Stocks: ownership in a company that can increase in value over time. Bonds: a loan to a company or government that pays you interest and returns your money at maturity. Mutual funds: a way to invest in a diversified portfolio of stocks, bonds, or other assets, managed by professionals. A critical strategy to reduce risk by spreading your investments across different assets. Avoid common mistakes. Don't try to time the market, diversify your portfolio, and stay calm during market volatility. Investing doesn't require perfection, it just requires action. You don't need to know everything to get started. Even a small step today can set you on the path to financial independence. Pick one thing you've learned from this chapter, whether it's understanding stocks, bonds, or mutual funds, and start exploring. Open an account, make your first small investment, and begin your journey toward a financially free future. Remember, every successful investor started with their first step. Chapter 3. The Mindset Shift. Thinking like an investor. When it comes to investing, most people think the secret to success lies in picking the right stocks, bonds, or funds. And while making smart investment choices is important, there's something even more critical: your mindset. Many beginners make the mistake of focusing solely on quick gains or trying to beat the market. The reality is, successful investing requires patience, discipline, and long-term thinking. In this chapter, we'll discuss how to shift your mindset from a spender to an investor, setting the stage for your long-term financial success. One of the biggest barriers to becoming a successful investor is shifting from a consumer mindset to an investor mindset. A consumer mindset is focused on spending and instant gratification. Think of that feeling when you buy something new, like a gadget or a piece of clothing. It feels good in the moment, but over time, the value of what you've purchased often decreases. An investor mindset, on the other hand, is about delayed gratification. It's about putting your money into assets that will grow in value over time, even if it means making sacrifices today. This requires a major shift in how you think about money. Instead of asking, "How can I spend this?" start asking, "How can I make this grow?" Key differences between consumer and investor mindsets. Consumer focuses on spending and short-term pleasure. Investor focuses on building wealth and long-term financial freedom. Consumer wants immediate results. The investor understands the value of patience and delayed gratification. Here's the truth. Every dollar you choose to invest is a step toward financial freedom. Every dollar you spend is a missed opportunity for that dollar to grow. The power of patience. Successful investors understand that the market rewards those who are patient. This doesn't mean you'll never make quick gains, but those gains often pale in comparison to the wealth you can build over decades. The key to long-term wealth building is staying invested through the highs and lows, rather than trying to time the market or chase the latest hot stock. Let's break it down. Compounding over time. When you invest early and leave your money in the market, it grows exponentially due to compound interest, which we discussed in Chapter 1. The longer your money stays invested, the more it can grow, because each year's gains compound on the previous ones. Avoid emotional decisions. Markets will fluctuate, sometimes wildly. The investor mindset requires you to stay the course, even when markets dip. While it's tempting to sell when prices drop, this often locks in losses and prevents your investments from recovering when the market bounces back. Here's a way to think about it. Imagine planting a tree. You can't dig it up every few weeks to see if it's growing. It takes time, sunlight, and care. Over the years, that tree will grow strong, providing shade and bearing fruit. The same goes for your investments. The longer you nurture them, the more they'll provide in the long run. The role of discipline. Consistency over perfection. One of the biggest myths about investing is that you need to be perfect, always picking the right stocks, entering and exiting the market at the perfect time. But the truth is, consistency beats perfection. The most successful investors don't make flawless decisions every time, they stick to a disciplined, long-term approach. Here's what discipline looks like in investing. Consistent contributions. Whether you're putting in $50 or $500 a month, the secret is to stay consistent. By making regular investments, you benefit from both the highs and lows of the market. Sticking to your plan. It's tempting to chase the latest trends or feel anxious during market dips, but a disciplined investor stays focused on their long-term strategy, tuning out the short-term noise. Imagine you're on a long road trip. You don't stop driving just because you hit traffic or see a detour sign. You know that as long as you keep going, you'll eventually reach your destination. Investing is the same, keep moving forward, even when the road gets rough. The pitfalls of fear and greed. Emotional investing is one of the biggest challenges for beginners. It's easy to let fear and greed influence your decisions, which often leads to buying high and selling low, exactly the opposite of what you want to do. Understanding these emotions and how to manage them is key to developing an investor mindset. 1. Fear kicks in when markets drop. It's natural to feel like you should sell to avoid further losses. But historically, markets have always recovered, and selling in a panic often means locking in those losses instead of waiting for a recovery. Example. During the 2008 financial crisis, many investors sold their stocks at low prices out of fear, but those who held on saw their portfolios recover and grow significantly in the years following. 2. Greed can cause investors to take unnecessary risks, like buying into a stock because it's trending or skyrocketing in value. This is often a recipe for disaster, because by the time a stock becomes a hot commodity, its price may already be inflated. Example. In the early 2000s, many investors piled into tech stocks during the dot-com boom. When the bubble burst, many of those stocks lost most of their value, and investors who had bought in during the hype were left with huge losses. Create an investment plan based on your long-term goals and stick to it, regardless of what your emotions are telling you in the moment. Staying the course. Why time in the market beats timing the market. Many beginners think they can beat the market by perfectly timing their buys and sells. But even professional investors struggle with this, and trying to time the market can lead to costly mistakes. Instead, focus on spending time in the market. Here's why. Market timing is risky. Trying to buy at the lowest point and sell at the highest point rarely works because markets are unpredictable. Studies have shown that if you miss the best days in the market, your overall returns can drop significantly. In other words, if you're trying to time the market and end up sitting out during a major upswing, you'll miss out on key gains. Example. From 1996 to 2016, if you missed just the 10 best days in the stock market, your returns would have been cut nearly in half. The takeaway? Staying invested for the long haul is almost always a better strategy than trying to jump in and out of the market. It's the discipline and consistency that pay off over time. To adopt an investor mindset, you need a long-term strategy. This strategy is your roadmap, guiding you through the ups and downs of the market. While your goals and risk tolerance will evolve over time, having a plan ensures you stay on track. Here's how to create a basic strategy. 1. Set clear goals. What are you investing for? Retirement? Buying a home? Building wealth for your family? Define your financial goals and create a timeline for each. 2. Assess your risk tolerance. Are you willing to take on more risk for potentially higher returns? Or would you prefer a more conservative approach? Understanding your comfort level with risk will help you decide what types of investments to focus on. 3. As we discussed in Chapter 2, diversification is key to reducing risk. Spread your investments across different asset classes like stocks, bonds, and mutual funds. 4. Commit to regular contributions. Whether it's weekly, monthly, or quarterly, Commit to regularly adding money to your investments. This helps you avoid emotional decision-making and takes advantage of dollar-cost averaging. Key takeaways. Shift your mindset. Transition from thinking like a consumer spending for immediate gratification to thinking like an investor building wealth over time. Long-term thinking is critical. The market rewards patience. Stay invested through market fluctuations, and avoid trying to time the market. Consistency in investing, even in small amounts, is more important than making perfect decisions. Emotions can derail your strategy. Recognize how fear and greed affect your investment choices, and learn to stick to your plan. Set clear goals, assess your risk tolerance, diversify your portfolio, and commit to regular contributions. Success in investing starts in your mind. Developing an investor mindset is the foundation that will help you build wealth and achieve financial independence. It's not about perfection, it's about patience, discipline, and staying the course, even when things get tough. As you move forward, remind yourself that every dollar you invest today is a step toward a better future. The journey won't always be easy, but with the right mindset, you'll have the tools to navigate any market and reach your financial goals. Chapter 4. The Power of Compounding in Time. Albert Einstein allegedly called compound interest the eighth wonder of the world, and for good reason. It has the potential to turn small, consistent investments into substantial wealth over time. In this chapter, we're going to dive into one of the most powerful forces in investing, compounding. Whether you're investing in stocks, bonds, or mutual funds, the concept of compounding works the same way, and the earlier you start, the more time your money has to grow. By the end of this chapter, you'll understand why time is your best friend when it comes to building wealth. What is compounding? Compounding is the process of earning interest not just on your original investment, but also on the interest that accumulates over time. It's like a snowball rolling downhill. At first, it starts small, but as it continues to roll, it picks up more snow, growing bigger and bigger and bigger as it goes. Let's break it down. When you invest money, you earn returns. For example, if you invest $1,000 and earn a 7% return in a year, you now have $1,070. In the next year, you earn 7% not just on your original $1,000, but on the entire $1,070. This means your returns start to generate their own returns. This is compounding at work. The longer your money stays invested, the more powerful the effect of compounding becomes. The power of starting early. One of the most crucial lessons in investing is that time in the market is more valuable than trying to time the market. This is where the magic of compounding truly takes effect. The earlier you begin, the more time your money has to grow, even if you're starting with a modest amount. Here's a simple example. Robert starts putting away $200 a month at age 25 and stops at age 35, investing for just 10 years. After that, Robert lets the money grow untouched until retirement at age 65. On the other hand, Becky doesn't start investing until age 35, but contributes $200 per month for 30 years, all the way until age 65. Surprisingly, even though Becky contributed for 30 years compared to Robert's 10 years, Robert ends up with more money at retirement. Why? Because of the extra time their money had to grow through compounding. The earlier you start, the less you need to contribute to reach your financial goals. Time becomes the greatest asset in your investment journey. The Rule of 72. A quick way to estimate growth. The Rule of 72 is a simple formula to estimate how long it will take for your investment to double in value, based on a fixed annual rate of return. It's a useful tool to understand the power of compounding over time. Here's how it works. Take the number 72 and divide it by your expected annual return rate. The result is the number of years it will take for your investment to double. For example, if you expect an annual return of 6%, divide 72 by 6. The answer is 12, meaning it will take roughly 12 years for your investment to double. If your return rate is higher, say 9%, divide 72 by 9, and you get 8 years. Why it matters. This simple rule highlights how important it is to get your money working for you as early as possible. The more time your money has to compound, the faster it can grow. Starting early can significantly shorten the time needed to double your investments, putting you on a faster track toward financial independence. Let's look at some real-world examples to see how powerful compounding can be over time. Example 1. The 25-year-old investor. Imagine you start investing $5,000 per year at age 25, earning an average annual return of 7%. By the time you're 65, that $5,000 per year investment will have grown to roughly $1.2 million, assuming you contribute for 40 years. Example 2. The 35-year-old investor. Now let's say you wait until age 35 to start investing the same $5,000 per year. By age 65, your investment would grow to about $580,000. That's a significant difference, all because the first investor started 10 years earlier. What do these examples show? The earlier you start investing, the greater your results will be over time, without having to invest more money. Time does the heavy lifting. Compounding is a slow process at first, and this is where many people get discouraged. In the early years, your investment growth might seem small, and it's tempting to stop or spend the money instead. But the real magic happens later, after years of consistent investing. This is why delayed gratification is so important in investing. It's about resisting the urge to withdraw or spend your money early and instead letting it continue to grow. Think of it like planting a tree. At first, you don't see much growth. But over the years, with patience and care, that tree will grow stronger and eventually bear fruit. The longer you nurture it, the more valuable it becomes. When you understand the power of compounding, you'll see that each year you leave your money invested, you're building a foundation for future wealth. The pitfalls of starting late and how to recover. You might be thinking, I didn't start early, is it too late for me? The answer is no. While starting early gives you a significant advantage, it's never too late to start investing and let compounding work for you. Here's how you can maximize compounding if you're starting later. Contribute more. If you're starting in your 40s or 50s, consider increasing your contributions to catch up. This might mean setting aside a larger portion of your income for investing. Maximize tax-advantaged accounts. Use retirement accounts like 401ks or IRAs to grow your money faster through tax benefits. These accounts can boost your compounding power by sheltering your investments from taxes while they grow. Stay invested longer. Consider delaying retirement or extending your investment horizon. The longer you keep your money working, the more you can take advantage of compounding, even if you start later. Remember, while starting early is ideal, the next best time to start is today. Compounding works best when your money has time to grow, so the sooner you begin, the better your results will be. Key takeaways. Compounding is powerful. It's the process of earning returns on both your original investment and your accumulated returns over time. Time is your best friend. The earlier you start, the more time your money has to grow, even if you're starting with small contributions. The Rule of 72. A quick way to estimate how long it will take for your investment to double. Patience is critical. Compounding is slow at first, but over time, your investments can grow exponentially. It's never too late. Even if you start later in life, you can still benefit from compounding by increasing contributions and extending your investment timeline. If there's one thing you take away from this chapter, let it be this: the best time to start investing is today. The power of compounding isn't about finding the perfect investment or trying to time the market. It's about giving your money the time it needs to grow. Whether you're 25 or 55, you have the ability to build wealth by harnessing the power of time. So what are you waiting for? Start now, be patient, and watch as the magic of compounding transforms your investments over time. Chapter 5. Setting smart financial goals. Investing without clear financial goals is like setting off on a road trip without knowing your destination. You might enjoy the journey for a while, but eventually you'll need a map to guide you to where you want to go. The same applies to investing. You need clear, well-defined goals to guide your decisions and ensure you're making progress toward financial independence. In this chapter, we'll explore how to set goals that aren't just dreams or vague aspirations but are achievable and measurable. We'll use the SMART framework, goals that are specific, measurable, achievable, relevant, and time-bound, to help you build a clear roadmap to financial success. Why financial goals matter. Many people start investing without clear goals, thinking they'll figure it out as they go. But the truth is, investing becomes far more effective when it's aligned with specific objectives. Without goals, it's easy to get distracted by short-term market movements, react emotionally to news, or chase after quick profits. Clear goals keep you focused on what truly matters, long-term success rather than short-term gains. Motivation. Defined goals give you something concrete to work toward. keeping you motivated during challenging times. Accountability. Goals allow you to measure your progress and adjust your strategy as needed. When you know exactly what you're aiming for, whether it's buying a home, funding your child's education, or retiring comfortably, your investment strategy will be more purposeful, and your chances of achieving financial independence will increase. The SMART framework is a widely used tool for setting goals in various areas of life, and it's particularly effective for financial planning. By making your goals specific, measurable, achievable, relevant, and time-bound, you give yourself a clear target and the steps necessary to reach it. Here's how the SMART framework applies to your financial goals. 1. Specific. Your goal should be clear and well-defined. Instead of saying, "I want to retire comfortably," say, "I want to retire with $1 million in my investment account by age 65. A specific goal gives you a concrete target to aim for. 2. Measurable. Your goal should include milestones and metrics you can track. For example, "I will save $500 per month for retirement" is measurable because you can easily track your monthly contributions. 3. Achievable. Set a goal that is realistic based on your current financial situation. While it's important to aim high, your goals should be attainable. For example, if you're currently saving $100 per month, aiming to save $5,000 per month next year might not be feasible. Start with something achievable and adjust as your income and savings grow. 4. Relevant. Your financial goals should align with your personal values and long-term objectives. If retiring early is your dream, your goals should reflect that priority. Similarly, if homeownership is important, focus on a savings plan that helps you get there. 5. Time-bound. Every goal needs a deadline. Whether it's a 5-year plan to save for a house or a 30-year plan for retirement, giving yourself a time frame adds urgency and structure to your goal. For example, "I want to save $100,000 for a home down payment in 5 years" provides a clear target with a specific deadline. Creating your own SMART goals. Now that you understand the SMART framework, let's put it into action. We'll start by identifying your main financial goals and then break them down into smaller, manageable pieces using the SMART criteria. This will create a roadmap that leads you step by step toward your ultimate goal of financial independence. Step 1. Identify your primary financial goal. Ask yourself, what's the most important financial milestone I want to achieve in the next 5, 10, or 20 years? This could be saving for retirement, paying off debt, building an emergency fund, buying a home, funding your child's education. Once you've identified your primary goal, apply the SMART framework to it. Example: specific. I want to save $100,000 for a home down payment. Measurable. I will save $1,500 per month. Achievable. I've calculated my monthly budget and adjusted my expenses to ensure I can consistently save $1,500 per month. Relevant. Owning a home is important to me, and I want to stop paying rent. Time-bound. I will save this amount in 5 years. Step 2. Break down large goals into smaller milestones. Large financial goals can seem overwhelming, but when broken down into smaller, more manageable milestones, they become much more attainable. If your goal is to save $100,000 in 5 years, break it down by year and by month. Yearly target $20,000, monthly target $1,667. These smaller milestones will make it easier to track your progress and make adjustments if needed. Prioritizing your goals. It's common to have more than one financial goal, but some goals will naturally take priority over others. The key is to understand which goals are most urgent and important to you right now. Here's a simple way to prioritize your goals. Short-term goals. These are goals you want to achieve within the next 1 to 3 years, like building an emergency fund or paying off high-interest debt. Mid-term goals. These are goals with a 3 to 10-year horizon, such as saving for a down payment on a home or starting a college fund for your children. Long-term goals. These are your goals for 10 years or more down the road, such as retirement or passing on wealth to the next generation. Focus on balancing your short-term and long-term goals. For example, while saving for a house may be a priority, you can still contribute a smaller amount to your retirement fund to ensure you're making progress on both. Staying on track, monitoring and adjusting your goals. Setting goals is only the first step. To ensure you reach them, you need to regularly monitor your progress and make adjustments as needed. 1. Track your progress. Check in on your goals every few months. Are you saving as much as you planned? Are there areas where you can cut back on expenses to boost your savings? 2. Celebrate milestones. Each time you hit a smaller goal, whether it's saving $10,000 toward your home down payment or reaching your first $1,000 in an emergency fund, celebrate the win. Recognizing your progress will keep you motivated. 3. Be flexible. Life happens, and sometimes you'll need to adjust your goals. Maybe an unexpected expense comes up, or you need to shift your priorities. That's okay. Adjust your timeline, reset your goals if necessary, and keep moving forward. The key to staying on track is consistency. Even if you can't meet every milestone exactly, continuing to save and invest will keep you moving toward your ultimate goal of financial independence. Let's look at a few examples of how you can apply SMART goals to different financial objectives. 1. Goal. Specific. I want to pay off $15,000 in credit card debt. Measurable. I will pay $500 per month toward my debt. Achievable. I've reviewed my budget and cut unnecessary expenses to allocate $500 each month. Relevant. Becoming debt-free will improve my financial security. Time-bound. I will pay off my debt in 30 months. 2. Goal. Save for retirement. Specific. I want to have $500,000 in my retirement account by age 60. Measurable. I will contribute $500 per month to my retirement fund. Achievable. I've calculated that, with an average return of 7%, this contribution will help me reach my goal. Relevant. Saving for retirement is critical to ensure I can live comfortably without relying on work. Time-bound. I will save this amount over the next 25 years. 3. Goal. Build an emergency fund. Specific. I want to save $10,000 for emergencies. Measurable. I will save $250 per month. Achievable. I've identified expenses I can reduce to free up $250 each month. Relevant. Having an emergency fund will provide me with financial peace of mind. Time-bound. I will save this amount in 40 months. Key takeaways. SMART goals. Use the SMART framework: specific, measurable, achievable, relevant, time-bound to set clear financial objectives. Identify and prioritize. Start by identifying your most important financial goals and then prioritize them based on urgency and relevance to your long-term plans. Track progress. Regularly monitor your progress, celebrate milestones, and be flexible when life requires adjustments. Small steps matter. Even small, consistent contributions toward your goals will add up over time. Setting SMART financial goals is like creating a roadmap to your financial future. With clear goals in place, every investment, every savings plan, and every financial decision you make will have purpose and direction. Whether you're saving for retirement, paying off debt, or building an emergency fund, SMART goals will guide you toward financial independence, one step at a time. Start today by setting your first SMART goal, and take the first step on your journey to financial freedom. Chapter 6. Building your first investment portfolio. Now that you've set your SMART financial goals, it's time to create the blueprint that will help you achieve them: your investment portfolio. A portfolio is essentially a collection of different types of investments, and how you build it will depend on your goals, risk tolerance, and the time you have to invest. In this chapter, we'll break down the steps to building your first investment portfolio. Whether you're saving for retirement, a down payment on a home, or another goal, creating a diversified portfolio will help you manage risk and maximize returns. By the end of this chapter, you'll know how to select the right mix of investments and create a balanced portfolio that aligns with your financial objectives. What is an investment portfolio? An investment portfolio is simply a collection of assets, such as stocks, bonds, mutual funds, and other investment vehicles that you own. Think of it like a toolbox. Just as you need different tools for different jobs, you need different types of investments to achieve different financial goals. Here's a breakdown of what your portfolio might include. Stocks. Shares of ownership in a company. Stocks have the potential for high returns but come with higher risk. Bonds. Loans you give to a company or government. Bonds are generally safer than stocks, but they also provide lower returns. Mutual funds. A collection of stocks, bonds, or other securities, managed by a professional. Mutual funds offer instant diversification and are great for beginners. Real estate. Properties you own and rent out or sell for a profit. Real estate can be a solid long-term investment. ETFs, exchange-traded funds. Similar to mutual funds but traded like individual stocks on the stock market. They offer diversification with lower fees than mutual funds. Step 1. The first step in building your portfolio is assessing your risk tolerance, how much risk you're comfortable taking on in pursuit of your goals. This is one of the most important factors in deciding what investments to include in your portfolio. Risk tolerance is influenced by factors like your age. Younger investors generally have a higher risk tolerance because they have more time to recover from market downturns. Older investors, especially those nearing retirement, tend to prefer safer investments to protect their savings, their financial goals. If you're investing for long-term goals like retirement, you may be able to take on more risk. But if your goal is short-term, such as saving for a house in the next few years, you might want to invest more conservatively. Some people are naturally more comfortable with market fluctuations. Others might panic at the first sign of a downturn. Knowing your emotional reaction to risk will help you create a portfolio that you can stick with. If you're young and investing for retirement, you might be comfortable with a portfolio that's 80% stocks and 20% bonds, because stocks tend to perform better over the long term. If you're approaching retirement, you might shift to a more conservative portfolio with 40% stocks and 60% bonds to protect your savings from market volatility. Step 2. Setting your asset allocation. Once you've assessed your risk tolerance, the next step is to decide on your asset allocation, how you'll divide your money among different types of investments. Asset allocation is one of the most important factors in determining your portfolio's long-term success. Here's a basic guide to asset allocation based on risk tolerance. Aggressive high risk. 80 to 100% stocks, 0 to 20% bonds, moderate medium risk. 60 to 80% stocks, 20 to 40% bonds. Conservative low risk. 40 to 60% stocks, 40 to 60% bonds. The idea behind asset allocation is simple. By spreading your money across different asset classes, you can reduce risk. For example, if the stock market takes a hit, the bonds in your portfolio might help cushion the blow, because they tend to perform better when stocks are down. Step 3. Diversification. Don't put all your eggs in one basket. Diversification is one of the key principles of smart investing. It's a strategy that reduces risk by spreading your money across different types of investments, so you're not overly exposed to any single asset. Here's why diversification is important. Risk reduction. Different types of investments respond differently to market conditions. If you only own stocks and the market crashes, your entire portfolio could suffer. But if you own a mix of stocks, bonds, and other assets, some may hold their value or even increase during a downturn. A diversified portfolio tends to experience less extreme ups and downs. While diversification won't eliminate risk, it can make your portfolio more stable over time. Practical example. Let's say you own shares in a tech company and bonds from a government. If the tech industry experiences a downturn, the value of your stocks may drop. However, bonds often perform well in uncertain times, so they might offset the losses in your stock holdings. This balance keeps your overall portfolio steadier and protects you from large losses. Step 4. Now that you've determined your risk tolerance, asset allocation, and diversification strategy, it's time to select your individual investments. Here are some options to consider. 1. Individual stocks. If you're comfortable picking stocks, you can invest in individual companies that you believe will grow. However, this comes with more risk, as individual stocks can be volatile. 2. Bonds. You can choose between government bonds, typically safer but with lower returns, or corporate bonds, higher risk, but with potentially higher returns. 3. Mutual funds and ETFs. These are great options for beginners because they provide diversification in one package. A mutual fund, or ETF, might include hundreds or even thousands of different stocks and bonds, spreading your risk. 4. Target date funds. If you're investing for retirement, a target date fund automatically adjusts your asset allocation as you approach your target retirement date. This is a hands-off way to invest, providing diversification and adjusting your risk level over time. When choosing individual investments, make sure they align with your overall strategy. For example, if you've decided on a moderate risk portfolio, don't put all your money into high-risk stocks. Balance your choices to match your asset allocation plan. Step 5. Rebalancing your portfolio. Once your portfolio is built, you'll need to monitor it over time and make adjustments as necessary. This is where rebalancing comes in. Over time, some investments in your portfolio will grow faster than others, which can shift your asset allocation away from your original plan. Let's say you started with a portfolio of 70% stocks and 30% bonds. If your stocks perform really well, your portfolio might shift to 80% stocks and 20% bonds. This would make your portfolio riskier than you originally intended. To fix this, you would rebalance your portfolio by selling some of your stocks and buying more bonds, bringing your allocation back to 70% stocks and 30% bonds. Rebalancing ensures that your portfolio stays aligned with your goals and risk tolerance. You don't need to rebalance constantly, once or twice a year is usually enough. Just check in periodically to make sure your asset allocation hasn't drifted too far off course. Common mistakes to avoid when building a portfolio. When building your portfolio, it's easy to make mistakes that can undermine your long-term success. Here are some common pitfalls to watch out for. 1. Putting all your money into one type of investment, like only buying tech stocks, can be risky. Always diversify to reduce the impact of a downturn in any one sector. 2. Don't try to predict when the market will go up or down. It's nearly impossible to consistently time the market, and most investors who try end up missing out on gains. 3. Ignoring fees. Some investments come with high management fees which can eat into your returns. Be sure to check the fees on mutual funds and ETFs before investing. Look for low-cost options that align with your goals. 4. Focusing too much on short-term results. Investing is a long-term game. Don't panic if your portfolio dips in value over a few months or even a year. Stick to your plan and give your investments time to grow. Key takeaways. Your portfolio is your financial toolbox. It should include a variety of investments like stocks, bonds, and mutual funds, each serving a different purpose. Assess your risk tolerance. Your risk tolerance will determine how much of your portfolio should be in stocks versus safer assets like bonds. Diversification is key. Spread your investments across different asset classes to reduce risk and create a more stable portfolio. Rebalance regularly. Keep your portfolio aligned with your goals by rebalancing when necessary. Avoid common mistakes. Don't try to time the market or put all your money in one type of investment. Focus on long-term growth and keep fees low. Building an investment portfolio is a personal journey, and it's one of the most powerful steps you can take toward financial independence. Your portfolio is the engine that will drive you toward your goals, whether it's retiring comfortably, buying a home, or creating generational wealth. As you build your portfolio, remember that it's not about perfection, it's about progress. Stay committed to your long-term goals, regularly review your investments, and make adjustments as needed. Your portfolio is more than just a collection of stocks and bonds, it's your blueprint for a better financial future. Chapter 7. Overcoming Fear. Investing in Uncertain Markets. Every investor, beginner or seasoned, has felt fear at some point. Whether it's fear of losing money, fear of a market crash, or fear of making the wrong investment decision. But what separates successful investors from the rest is their ability to navigate uncertainty with confidence. In this chapter, we'll talk about how to overcome fear when investing in uncertain markets. You'll learn practical strategies to manage your emotions, stay the course, and make decisions based on logic rather than fear. By the end of this chapter, you'll have the tools to maintain your composure in both good times and bad, allowing you to stick to your long-term investment plan, no matter what the market throws your way. Why fear is a natural part of investing. It's important to start by acknowledging that fear is a natural and normal part of investing. We're wired to avoid loss, so when we see the value of our investments drop, it triggers an emotional response. But successful investing isn't about avoiding fear, it's about learning how to manage it. Fear often stems from uncertainty. When markets are volatile or the economy is unpredictable, it's easy to feel anxious and question your investment choices. But here's the truth: uncertainty is part of the investing landscape, and it's something every investor must learn to navigate. The good news is, you can train yourself to think like a successful investor. By shifting your mindset and using the right strategies, you can overcome the fear of market uncertainty and stay focused on your long-term goals. The emotional side of investing. Fear and greed. Two emotions dominate the investing world: fear and greed. Both can lead to poor decisions, so it's essential to recognize these emotions and understand how they impact your behavior. 1. Fear. Fear often causes investors to panic and sell during market downturns, locking in losses instead of riding out the storm. Fear can also cause paralysis, where you're too afraid to invest at all, missing out on long-term growth opportunities. 2. Greed. On the other side of the spectrum is greed. This emotion tempts investors to take excessive risks in the pursuit of quick gains, often leading to speculative decisions that backfire. Greed can push you to chase hot stocks or time the market, which rarely works out well in the long run. Understanding that fear and greed are two sides of the same coin is key. Both emotions cloud judgment and lead to reactive decisions. The goal is to stay balanced, recognizing these emotions but not letting them control your investment strategy. Managing fear with a long-term perspective. The best way to manage fear when investing is to adopt a long-term perspective. Markets go through cycles of ups and downs, but over time they tend to grow. This means that short-term market fluctuations, while stressful, are often just temporary blips in the context of a longer journey. Here's why a long-term perspective matters. Historical market performance. Historically, the stock market has always recovered from downturns. Even during significant crashes, like the 2008 financial crisis or the COVID-19 pandemic in 2020, the market eventually rebounded, and long-term investors were rewarded for their patience. Time in the market beats timing the market. Trying to predict market highs and lows is nearly impossible, and investors who attempt to time the market often miss out on the best days of market growth. The real power comes from staying invested over time, allowing compounding and growth to do their work. Imagine an investor who sold all their stocks during the 2008 financial crisis out of fear. If they stayed out of the market, they would have missed the massive recovery that followed in the subsequent years. In contrast, investors who stayed calm and focused on their long-term goals saw their portfolios recover and grow significantly. Focus on the big picture. Stay invested through the ups and downs, and remember that temporary market declines don't define your long-term success. To overcome fear when investing in uncertain markets, it helps to have a set of practical strategies you can rely on when emotions run high. Here are several techniques to help you manage fear and stay focused on your long-term plan. 1. Stick to your investment plan. If you've set up a well-diversified portfolio with a strategy that matches your risk tolerance, trust the process. Stick to your plan rather than reacting to short-term market movements. 2. Dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. Dollar cost averaging helps you avoid trying to time the market and smooths out your investments over time, reducing the emotional impact of market volatility. 3. Focus on your goals, not the market. When markets are turbulent, it's easy to get caught up in daily headlines and stock prices. Instead, remind yourself of your long-term goals, whether it's saving for retirement, a house, or your children's education, and focus on the progress you're making toward those goals. 4. Limit your exposure to financial news. Constantly checking stock prices or reading negative news can increase your anxiety and fear. Try to limit your exposure to daily market fluctuations, especially during times of uncertainty. 5. If market volatility is making you uncomfortable, it might be time to reassess your risk tolerance and adjust your asset allocation. Shifting to a more conservative portfolio could help you feel more secure, especially if you're approaching retirement or have short-term financial goals. Building emotional resilience. Handling market volatility. Investing is as much an emotional journey as it is a financial one. To become a successful investor, you need to build emotional resilience, the ability to stay calm and composed when the market takes a dive. Here are a few ways to develop that resilience. Recognize that volatility is normal. The stock market has never been a straight line upward. There will always be periods of volatility, and while they may feel uncomfortable, they are a natural part of the market cycle. Focus on what you can control. You can't control the markets, but you can control how much you save, how often you invest, and how diversified your portfolio is. Focusing on these factors will give you a sense of control and reduce anxiety. Knowing you have a safety net for unexpected expenses can help reduce fear during market downturns. Your emergency fund acts as a buffer, so you won't need to sell investments at a loss if the market drops. The investor who stayed the course. Let's look at a real-world example to show the benefits of staying invested during uncertain times. Meet Sarah, a long-term investor who started building her portfolio in her 30s. In 2008, during the financial crisis, Sarah saw her investment portfolio drop by 40%. Naturally, she felt fear, but instead of panicking, she reminded herself of her long-term goals, saving for retirement. She continued to contribute to her portfolio every month, following a dollar cost averaging strategy. By the time she reached her 50s, not only had her portfolio recovered, but it had grown significantly beyond its pre-crash value. The lesson here is clear: by overcoming fear and sticking to her plan, Sarah was able to reap the rewards of long-term investing. Staying the course and continuing to invest during downturns can lead to greater financial success in the long run. Fear is natural. Every investor experiences fear, especially during uncertain times. The key is to manage it, not let it control your decisions. Focus on your long-term goals and remind yourself that market fluctuations are temporary. Practical strategies: use techniques like dollar cost averaging, limiting your exposure to financial news, and sticking to your plan to manage fear during market volatility. Building emotional resilience will help you stay calm and focused, even when the market is volatile. Trust the process, stay the course. Investing in uncertain markets requires courage and discipline. But if you can overcome the emotional roller coaster, you'll be rewarded with the growth and wealth that come from sticking to your plan. Remember, it's not about being perfect or predicting the market, it's about trusting the process and staying the course. The markets will rise and fall, but your ability to remain calm and focused will determine your long-term success. Keep your eyes on the horizon, and know that each step you take brings you closer to financial freedom. Chapter 8. Understanding Risk and Reward. One of the most fundamental principles of investing is the relationship between risk and reward. Every investment decision involves a trade-off between the two. The higher the potential reward, the higher the risk, and vice versa. In this chapter, we'll break down what risk really means in the context of investing, how to manage it, and how to find a balance that aligns with your financial goals. By the end of this chapter, you'll understand how to embrace risk thoughtfully and use it to your advantage without letting it overwhelm you. What is risk? In the context of investing, is the possibility that the return on your investment will be lower than expected, or, in some cases, that you may lose money. All investments carry some level of risk, whether it's the risk of losing value, missing out on potential gains, or not meeting your financial goals. Here are some common types of risk in investing. Market risk. The risk that the overall stock market will decline, impacting the value of your investments. The risk that changes in interest rates will affect the value of bonds or other interest-sensitive investments. The risk that the purchasing power of your money will decrease due to inflation, eroding the real value of your investment returns. Credit risk. The risk that a company or government issuing a bond will default on its payments. Risk is unavoidable, but it's important to remember that not all risks are created equal. Some are more significant than others, and understanding the specific risks tied to your investments is the first step toward managing them effectively. What is reward? Reward, on the other hand, is the potential gain you can earn from an investment. This could come in the form of dividends, interest, or capital appreciation, the increase in the value of the investment over time. The relationship between risk and reward is straightforward generally. The greater the potential reward, the greater the risk you'll need to take on to achieve it. Here's a quick breakdown of the types of returns you might receive from various investments. Stocks. Potential for high returns through price appreciation and dividends, but also higher risk due to market volatility. Bonds. Provide more stable, predictable returns through interest payments, but offer lower potential returns compared to stocks. Real estate. Can provide a mix of steady income through rental payments and long-term appreciation, but comes with liquidity risks and requires active management. Mutual funds, ETFs. These offer diversification and, depending on the assets within the fund, can balance both risk and reward. The risk-reward trade-off. Why you can't have one without the other. The risk-reward trade-off is one of the central concepts in investing. In simple terms, if you want higher returns, you have to be willing to accept more risk. Conversely, if you want to minimize risk, you'll likely need to accept lower returns. Let's look at an example. High-risk investment. Investing in a small tech startup. The potential reward is high, because if the company becomes successful, your investment could grow substantially. However, the risk is also high. Many startups fail, and you could lose all or part of your investment. Low-risk investment. A government bond. The potential reward is lower, because bonds tend to provide stable but modest returns. However, the risk is also low because government bonds are considered safe, especially in countries with strong economies. The key to successful investing is understanding your own risk tolerance and how much risk you're comfortable taking in pursuit of your goals. Some people are naturally more risk-averse and prefer the safety of bonds or conservative investments, while others may embrace the potential of higher-risk assets like stocks or real estate. How to assess your risk tolerance? Your risk tolerance is the amount of risk you're willing to take on in pursuit of financial reward. Everyone's tolerance for risk is different, and it's based on several factors, including your financial goals, time horizon, and personality. Here's how to determine your risk tolerance. 1. Age and time horizon. Younger investors generally have a higher risk tolerance because they have more time to recover from potential losses. If you're in your 20s or 30s and investing for retirement, you can afford to take on more risk. Conversely, if you're nearing retirement, you might prioritize preserving your capital and avoiding risk. 2. Financial situation. Your risk tolerance is also influenced by your financial situation. If you have an emergency fund and other financial security, you might be more comfortable taking on higher risk investments. If you're living paycheck to paycheck, you may want to focus on safer investments until you build more financial stability. 3. Emotional comfort. Risk tolerance isn't only about the numbers, it's also about how you feel. Some people are more at ease with the market's fluctuations and can handle the ups and downs of high-risk investments. Others might find themselves losing sleep over the possibility of losses. Understanding your emotional reaction to risk is crucial, and your investments should reflect that comfort level. A good rule of thumb is to regularly reassess your risk tolerance as you age or as your financial situation changes. You don't have to lock into one risk level forever. Your portfolio should evolve with you. Diversification and asset allocation. Managing risk is a crucial part of building a successful investment portfolio. While you can't eliminate risk, you can take steps to minimize it and ensure it aligns with your financial goals. Two of the most effective ways to manage risk are diversification and asset allocation. 1. Diversification. As we discussed in Chapter 6, diversification means spreading your investments across different asset classes, stocks, bonds, real estate, to reduce the impact of any one investment underperforming. This strategy smooths out the highs and lows, helping protect your portfolio from extreme swings. 2. Asset allocation is how you divide your investments between different types of assets. It's the key driver of your portfolio's risk level. For example, an aggressive portfolio might have 80% in stocks and 20% in bonds, maximizing potential returns but also exposing you to higher risk. A conservative portfolio might have 40% in stocks and 60% in bonds, focusing on stability with lower returns. Practical example. Let's say you're a moderate risk investor. You might have a portfolio with 60% stocks, 30% bonds, and 10% in real estate or other alternative investments. This provides a good balance of growth potential from stocks and stability from bonds and real estate. The role of time in risk management. Time is one of the most powerful tools for managing risk. The longer you stay invested, the more you reduce the impact of short-term market fluctuations. Here's why. Short-term risk. If you're investing for a goal that's less than 5 years away, like saving for a down payment on a house, you'll want to minimize risk. This is because market volatility could erode the value of your investments in the short term. Long-term risk. If you're investing for retirement 20 or 30 years from now, you can afford to take on more risk because time is on your side. Over long periods, the stock market has historically trended upward, despite short-term drops. Align your investment time horizon with your risk level. For long-term goals, consider higher-risk investments for greater potential returns. For short-term goals, stick to safer, more stable options. Real-life example. Warren Buffett's risk approach. Warren Buffett, one of the most successful investors in history, often talks about risk in simple terms. Risk comes from not knowing what you're doing. Buffett doesn't avoid risk altogether. Instead, he manages it by investing in businesses he deeply understands. He believes in long-term value investing, buying companies he's confident will grow over time, even if they experience short-term volatility. His approach emphasizes that knowledge and patience can help mitigate risk and lead to substantial rewards. The more you learn about your investments and the longer you hold on to them, the better equipped you'll be to manage risk. Educating yourself and sticking to a long-term strategy are powerful tools in reducing risk and maximizing reward. Risk is unavoidable. Every investment comes with some level of risk, but not all risks are equal. Understanding the specific risks of your investments is the first step to managing them. Higher rewards generally require higher risk, and lower risk investments tend to offer more modest returns. Risk tolerance is personal. Your age, financial situation, and emotional comfort with volatility all influence how much risk you should take on. Manage risk. Diversification and asset allocation are key tools for managing risk in your portfolio. Align your investments with your time horizon and financial goals. Investing involves risk, but it's how you manage that risk that determines your success. The key is not to fear risk, but to understand it, embrace it, and align it with your financial goals. By diversifying your portfolio, choosing an asset allocation that matches your risk tolerance, and giving your investments time to grow, you can balance the risk-reward trade-off and achieve long-term success. Remember, taking on some level of risk is necessary to achieve meaningful rewards. The important thing is to take calculated risks that align with your personal financial roadmap. With the right strategies in place, you'll be well on your way to building a future of financial independence. Chapter 9. How to avoid common investment mistakes. Even the most successful investors have made mistakes along the way. The key is to learn from these mistakes and avoid them yourself. Investing is a long-term game, and while missteps are natural, they can often be costly. In this chapter, we'll cover some of the most common investment mistakes that beginners and even experienced investors make, and how you can avoid them. By the end of this chapter, you'll be better equipped to navigate the challenges of investing with a clear strategy that keeps you on track toward your financial goals. Mistake 1. Trying to time the market. One of the biggest mistakes investors make is trying to time the market, attempting to predict when the market will rise or fall, and making investment decisions based on these predictions. The idea is to buy low and sell high, but in reality, even professionals struggle to do this consistently. Why it's a mistake. Market timing requires you to make two perfect decisions, when to sell and when to buy back in. Missing either can severely impact your returns. Studies show that most investors who try to time the market end up missing the best days of market performance. If you're not in the market during these days, your returns could suffer significantly. Focus on time in the market. Instead of trying to time the market, the best approach is to stay invested and let time work in your favor. The longer you stay in the market, the more likely you are to benefit from overall growth, despite short-term volatility. For example, during the 2008 financial crisis, many investors panicked and sold their stocks. Those who stayed invested through the downturn saw their portfolios recover and grow in the following years, while those who sold missed out on the recovery. Mistake 2. Not diversifying enough. Another common mistake is failing to diversify your portfolio. Putting all your money into one stock, sector, or asset class is risky. If that investment performs poorly, it can have a devastating impact on your portfolio. Why it's a mistake. A lack of diversification exposes you to higher risk. If you invest heavily in one industry like tech or real estate, a downturn in that sector could wipe out much of your investment. Diversification helps smooth out returns by spreading risk across various types of investments. To avoid this mistake, aim to build a diversified portfolio that includes a mix of asset classes, such as stocks, bonds, mutual funds, and even real estate or alternative investments. The idea is to reduce the impact of any single investment performing poorly. Consider using mutual funds or ETFs to achieve instant diversification. These funds hold a variety of investments, reducing the risk of being overly exposed to any one area. Mistake 3. Letting emotions drive decisions. Investing can be an emotional experience, especially when the market is volatile. Fear and greed are powerful emotions that can cause investors to make irrational decisions, such as panic selling during a market downturn or buying into a stock simply because it's trending. Why it's a mistake. Emotional decisions often lead to buying high and selling low, which is the opposite of a successful investment strategy. Reacting to short-term market movements can throw your long-term investment plan off course. Stick to your plan. The best way to manage emotions is to create a solid investment plan based on your long-term goals and risk tolerance, and stick to it. This means resisting the urge to sell during market dips or chase after the latest hot stock. For example, if you had sold your investments during the COVID-19 market crash in early 2020, you would have missed the rapid recovery that followed. Those who stayed the course and stuck to their plans saw their portfolios bounce back and grow. Mistake 4. Ignoring fees and expenses. Fees and expenses might seem small, but over time, they can significantly eat into your investment returns. Whether it's high management fees for mutual funds or transaction fees for frequent trading, ignoring these costs can have a major impact on your overall performance. Why it's a mistake. Even a seemingly small annual fee can compound over time and reduce your total returns. For example, a 1% annual fee on a $100,000 portfolio could cost you tens of thousands of dollars in lost returns over several decades. Frequent trading can rack up transaction costs, which erode your profits. When choosing investments, pay close attention to the fees involved. Look for low-cost options like index funds or ETFs, which typically have lower management fees. Additionally, avoid unnecessary trading to reduce transaction costs. Use fee comparison tools available from most brokerage platforms to ensure you're not paying more than you need to. Mistake 5. Neglecting to rebalance your portfolio. Rebalancing your portfolio is the process of adjusting your asset allocation back to its original targets after market movements cause certain investments to grow or shrink. Many investors neglect this important step, which can result in a portfolio that no longer matches their risk tolerance. Why it's a mistake. Over time, certain investments like stocks may outperform others like bonds, causing your portfolio to become more heavily weighted in riskier assets than you originally intended. Failing to rebalance can lead to unintended risk, especially as you approach important financial milestones like retirement. To avoid this mistake, plan to rebalance your portfolio at least once or twice a year. This involves selling some of your overperforming assets and buying more of your underperforming ones to restore your original asset allocation. Example: if you started with a 60% stock, 40% bond portfolio, and your stocks perform really well, your portfolio might shift to 70% stocks and 30% bonds. Rebalancing would involve selling some stocks and buying more bonds to get back to your target allocation. Mistake 6. Overreacting to market news and trends. The financial media is filled with headlines designed to provoke strong emotions, from stories of impending market crashes to the latest can't-miss investment trend. Constantly reacting to this news can cause you to make impulsive decisions that harm your long-term strategy. Why it's a mistake. The market is full of noise, and reacting to every bit of news can lead to overtrading, which racks up fees and taxes while detracting from your long-term goals. Chasing trends can lead you into risky investments that don't align with your overall strategy. Focus on the big picture. It's important to tune out the daily noise of the markets and stick to your long-term plan. Unless there's a major change in your financial situation or goals, there's no need to adjust your strategy based on the latest headlines or trends. Limit the time you spend following daily market news. Checking your portfolio once a month or quarter is enough to stay informed without becoming overly reactive. Mistake 7. Failing to plan for taxes. Taxes are often overlooked by investors, but they can have a significant impact on your returns. Whether it's capital gains tax or taxes on dividends, failing to plan for taxes can result in paying more than necessary. Why it's a mistake. Selling investments at a profit can trigger capital gains taxes, which can reduce the money you have available to reinvest. Holding investments in taxable accounts instead of tax-advantaged accounts like IRAs or 401ks can result in paying taxes on dividends and interest. Use tax-advantaged accounts. To minimize taxes, take full advantage of tax-deferred or tax-free accounts like IRAs, 401ks, and Roth IRAs. These accounts allow your investments to grow without being taxed, either until you withdraw the money in the case of traditional accounts or forever in the case of Roth accounts. Tip: when selling investments in a taxable account, consider holding them for more than a year to qualify for the lower long-term capital gains tax rate. Avoid trying to time the market. Focus on staying invested over the long term rather than attempting to predict market movements. Diversify your portfolio. Spread your investments across different asset classes to reduce risk. Keep emotions in check. Stick to your investment plan and avoid making decisions based on fear or greed. High fees can erode your returns over time. Choose low-cost investment options where possible. Rebalance regularly. Ensure your portfolio stays aligned with your risk tolerance by rebalancing periodically. Tune out the noise. Don't overreact to market news or trends. Stay focused on your long-term goals. Plan for taxes. Use tax-advantaged accounts to minimize the impact of taxes on your investment returns. Mistakes are lessons, not failures. Mistakes are part of the investing journey, but the key is to learn from them. By recognizing common pitfalls and understanding how to avoid them, you'll be better prepared to navigate the ups and downs of the market. Remember, no investor is perfect. Even the most experienced investors have made costly mistakes, but what sets them apart is their ability to learn, adapt, and keep moving forward. Take these lessons to heart and continue refining your strategy. With patience, discipline, and a commitment to learning, you'll avoid the most common missteps and steadily move closer to your financial goals. Chapter 10. Growing your portfolio. Advanced strategies. By now you've learned the basics of investing and built a solid portfolio. But as you continue to grow your wealth, it's important to understand some advanced strategies that can help you enhance your portfolio's performance. These strategies go beyond simple asset allocation and diversification, offering ways to maximize returns, manage risk, and achieve your long-term financial goals. In this chapter, we'll explore advanced techniques like dollar-cost averaging, dividend reinvestment, using tax-efficient strategies, and incorporating alternative investments. Whether you're aiming to grow your wealth more aggressively or protect what you've built, these strategies will help you take your portfolio to the next level. Dollar-cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This technique reduces the impact of market volatility by spreading out your investment purchases over time. Here's how it works. Instead of trying to time the market, you invest the same amount at regular intervals, monthly or quarterly. Sometimes you'll buy when prices are high, and sometimes when prices are low, but over time, your cost per share averages out. DCA takes the guesswork out of investing and helps you avoid emotional decisions. Example. Let's say you invest $500 in an index fund every month for a year. In some months, the price of the fund may be high, and in others, it may be lower. By the end of the year, your average purchase price will reflect both the highs and lows, smoothing out the impact of market fluctuations. Dollar-cost averaging is especially helpful for beginners and long-term investors who want to steadily grow their portfolio without worrying about short-term market movements. Let your earnings compound. Many stocks and funds pay dividends, regular payments to shareholders based on the company's earnings. Dividend reinvestment allows you to automatically reinvest those dividends to buy more shares, which can accelerate the growth of your portfolio. Why it's powerful. By reinvesting dividends, you're not just earning a return on your original investment but also on the dividends you've already received. This creates a compounding effect, where your investment grows faster over time. Example. Imagine you own shares in a dividend-paying stock. Instead of receiving the dividends as cash, you reinvest them to buy more shares. Over time, as those additional shares generate their own dividends, the compounding process accelerates, helping your portfolio grow exponentially. Many brokerage platforms offer automatic dividend reinvestment plans (DRIPs), making it easy to reinvest your dividends without having to manually purchase more shares. Tax-efficient investing. Keeping more of what you earn. One of the most overlooked aspects of investing is managing taxes. By investing in a tax-efficient way, you can reduce the amount of money you lose to taxes and maximize your after-tax returns. Tax-advantaged accounts. 401ks and IRS. Contributions to these accounts are often tax-deferred, meaning you don't pay taxes on the money until you withdraw it in retirement. This allows your investments to grow tax-free for decades. Roth IRAs. Contributions are made with after-tax money, but your withdrawals in retirement are tax-free. This is especially powerful if you expect to be in a higher tax bracket later in life. When investing in taxable accounts, be mindful of capital gains taxes. Long-term capital gains on investments held for more than a year are taxed at a lower rate than short-term gains. Tax loss harvesting. This strategy involves selling investments that have lost value to offset gains from other investments, reducing your overall tax liability. Tip: work with a financial advisor or use tax-efficient investing tools to minimize taxes while maximizing your investment growth. Using index funds and ETFs for low-cost diversification. Index funds and exchange-traded funds ETFs are powerful tools for building a low-cost, diversified portfolio. Both types of funds track a specific index like the S&P 500 and provide broad market exposure with minimal fees. Index funds and ETFs typically have lower expense ratios compared to actively managed funds. This means more of your money stays invested and working for you. Diversification. With a single purchase, you get exposure to a wide range of stocks or bonds, reducing the risk of relying too heavily on any one investment. If you invest in an S&P 500 index fund, you're essentially buying a small piece of all 500 companies in the index. This provides instant diversification across different sectors and industries, reducing the impact of a downturn in any one area. Tip: Index funds and ETFs are great for long-term investors who want to keep costs low and benefit from broad market growth without constantly managing individual stocks. Once you've built a core portfolio of traditional investments like stocks and bonds, you may want to explore alternative investments to further diversify and enhance your returns. These include assets like real estate, commodities, private equity, and more. Many alternative investments don't move in sync with the stock market, making them useful for reducing overall portfolio volatility. Potential for higher returns. Some alternative investments, like real estate or private equity, can offer higher returns than traditional stocks and bonds, but they also come with higher risk. Common alternative investments: real estate. Investing in rental properties or real estate investment trusts, REITs, can provide steady income and long-term appreciation. Commodities. Assets like gold, silver, and oil can act as a hedge against inflation and market downturns. Private equity and venture capital. These investments allow you to invest in private companies, but they typically require a higher level of risk tolerance and a longer investment horizon. Alternative investments can be riskier and less liquid than traditional investments, so they should make up a smaller portion of your portfolio and be used to complement your core holdings. Leveraging dollar cost averaging with a growth focus. While dollar cost averaging is a powerful tool for beginners, you can also leverage it in more advanced strategies, especially if you're focused on growth. One approach is to increase the amount you invest during market downturns, known as value cost averaging. How it works. With value cost averaging, instead of investing a fixed amount every month, you adjust your contributions based on market performance. When the market dips, you invest more, taking advantage of lower prices. When the market rises, you invest less, allowing you to lock in gains. Tip: This strategy requires more active management and a higher risk tolerance, but it can enhance returns over time by allowing you to buy low more effectively. The power of compounding with advanced strategies. Let's look at a real-life example to illustrate how these advanced strategies can work together to grow your portfolio over time. Meet Mark, who started investing in his early 30s. He used dollar cost averaging to invest $500 each month in a low-cost S&P 500 index fund. Over the years, he reinvested his dividends and occasionally added to his portfolio during market dips. Mark also contributed to his Roth IRA, allowing his investments to grow tax-free. By the time he reached his 50s, Mark's portfolio had grown significantly. Thanks to the power of compounding, reinvesting dividends, and leveraging tax-efficient strategies, he was able to retire early with a comfortable nest egg. By combining basic strategies like dollar cost averaging and dividend reinvestment with more advanced approaches like tax-efficient investing and value cost averaging, you can significantly accelerate your portfolio's growth over time. Dollar cost averaging. Invest regularly, regardless of market conditions, to reduce risk and smooth out returns. Dividend reinvestment. Let your earnings compound by reinvesting dividends into more shares. Tax-efficient investing. Maximize your after-tax returns by using tax-advantaged accounts and strategies like tax loss harvesting. Low-cost diversification. Use index funds and ETFs to keep costs low while diversifying your portfolio. Alternative investments. Explore real estate, commodities, and private equity to add diversity and potentially higher returns to your portfolio. Advanced DCA. Leverage value cost averaging to increase your investment during market downturns for growth. Focus strategies. Evolving your strategy for long-term success. As you become more experienced in investing, it's important to evolve your strategy and consider advanced techniques to enhance your portfolio. Whether it's reinvesting dividends, using tax-efficient accounts, or exploring alternative investments, these strategies will help you grow your wealth more effectively while managing risk. Remember, the goal is not to chase quick gains but to build a portfolio that aligns with your long-term financial goals. By layering in these advanced strategies, you'll create a well-rounded, resilient portfolio that can weather market volatility and keep growing over time. Chapter 11. Understanding taxes and fees. When it comes to investing, many people focus on maximizing returns, but often overlook how much taxes and fees can eat into those gains. Even small fees and taxes can have a significant impact on your portfolio's growth over time. In this chapter, we'll explore how taxes and fees affect your investments, how to minimize their impact, and the best strategies for keeping more of your hard-earned money. By the end of this chapter, you'll understand the importance of tax-efficient investing and low-cost investment options to protect your portfolio from unnecessary costs and maximize your returns. How investment fees can erode your returns. One of the biggest threats to your investment returns is fees. These fees may seem small on the surface, but over time, they can significantly reduce the amount of money you accumulate. Types of investment fees. 1. Expense ratios. The management fee charged by mutual funds and ETFs, expressed as a percentage of your investment. The higher the expense ratio, the more of your returns are eaten up by fees. For example, if you invest in a mutual fund with a 1% expense ratio, that means you're paying 1% of your total investment each year to the fund manager. Over time, this can compound into a significant cost. 2. Trading fees. These are the fees you pay to buy or sell stocks, bonds, or funds. While many brokerage platforms have moved to commission-free trading, it's important to be aware of any hidden fees. 3. Advisory fees. If you work with a financial advisor, you may pay a percentage of your assets under management as an advisory fee. Typical fees range from 0.5% to 1% per year, but these can add up over time. Why it matters. Fees compound over time, just like your investment returns. The more you pay in fees, the less you have working for you in the market. Even a small difference in fees can lead to a significant difference in your portfolio's value over decades. A portfolio with a 0.5% fee can grow much larger than one with a 1.5% fee over the long term. Solution: choose low-cost investment options. To minimize the impact of fees, look for low-cost investments like index funds and ETFs with low expense ratios. These funds typically have fees below 0.1% and still offer broad market exposure. The impact of taxes on your investments. Taxes can have a major effect on your investment returns, and understanding how they work is crucial for optimizing your portfolio. The two main taxes that affect investors are capital gains taxes and dividend taxes. Capital gains taxes. When you sell an investment for more than you paid for it, the profit you make is called a capital gain, and it's subject to tax. Short-term capital gains. Gains on investments held for less than a year are taxed as ordinary income, which is typically a higher rate. Long-term capital gains. Gains on investments held for more than a year are taxed at a lower rate, 15% or 20%, depending on your income bracket. Dividend taxes. Dividends you receive from stocks or mutual funds are also subject to tax. Qualified dividends. These are taxed at the lower long-term capital gains rate. Non-qualified dividends. These are taxed as ordinary income, which can be much higher. Why it matters. Taxes can significantly reduce your returns, especially if you frequently buy and sell investments. Holding investments for the long term allows you to take advantage of lower tax rates. Proper tax planning can help you keep more of your profits and minimize unnecessary tax burdens. Solution: tax-efficient investing. To minimize taxes, aim to hold investments for more than a year to take advantage of long-term capital gains tax rates. Use tax-advantaged accounts like IRS or 401ks to shelter your investments from taxes. Reinvest dividends in tax-advantaged accounts to avoid paying taxes on them in the short term. Tax-advantaged accounts. Maximizing your savings. Investing in tax-advantaged accounts is one of the most effective ways to reduce your tax liability and grow your wealth faster. These accounts allow your investments to grow either tax-free or tax-deferred, depending on the type of account. Types of tax-advantaged accounts. 1. Traditional IRA 401k. Contributions are tax-deferred, meaning you don't pay taxes on the money you contribute until you withdraw it in retirement. This allows your investments to grow without being taxed every year. You pay taxes when you withdraw the money during retirement, typically at a lower tax rate if your income is lower at that time. 2. Roth IRA 401k. Contributions are made with after-tax money, but withdrawals in retirement are completely tax-free. This is especially valuable if you expect to be in a higher tax bracket when you retire. All earnings on your investments grow tax-free, and you won't owe taxes when you withdraw the money, as long as you meet the age and holding period requirements. 3. Health Savings Account. HS offer a triple tax advantage: contributions are tax deductible, investments grow tax-free, and withdrawals for qualified medical expenses are tax-free. Additionally, once you reach age 65, you can use HSA funds for any purpose without penalty, though they'll be taxed if not used for medical expenses. Why it matters. Tax-advantaged accounts allow your investments to compound more efficiently because you're not losing a portion of your returns to taxes every year. Choosing the right type of account, based on your financial goals, can make a significant difference in your overall wealth over time. Solution: max out your contributions. Whenever possible, aim to contribute the maximum amount allowed to your tax-advantaged accounts each year. This ensures you're making the most of the tax benefits available to you. Minimizing taxes in taxable accounts. If you've maxed out your contributions to tax-advantaged accounts or want to invest additional funds, you'll likely be investing in taxable accounts. While these accounts don't offer the same tax benefits as IRAs or 401ks, there are still strategies you can use to minimize your tax liability. Strategies for taxable accounts. 1. Tax loss harvesting. This strategy involves selling investments that have lost value to offset gains from other investments. You can use these losses to reduce your taxable capital gains and lower your overall tax bill. 2. Hold investments long term. As mentioned earlier, holding investments for more than a year allows you to benefit from the lower long-term capital gains tax rates. This can make a significant difference compared to the higher rates on short-term gains. 3. Invest in tax-efficient funds. Some mutual funds and ETFs are specifically designed to minimize taxable distributions by limiting the turnover of their holdings. These funds can be a good choice for taxable accounts. Why it matters. In taxable accounts, you'll owe taxes on both capital gains and dividends. By using strategies like tax loss harvesting and holding investments for the long term, you can significantly reduce your tax burden. Consider working with a tax professional or using tax-efficient investing software to help manage your taxable accounts effectively. Hidden fees. What to watch out for. In addition to the more obvious fees like expense ratios and trading costs, there are hidden fees that can add up over time and reduce your returns. Common hidden fees. Load fees. Some mutual funds charge load fees, which are sales charges paid when you buy or sell the fund. These fees can range from 1% to 5% and should be avoided whenever possible. 12b1 fees. These are marketing and distribution fees charged by some mutual funds, and they can increase the overall expense ratio of the fund. Look for funds with low or no 12b1 fees. Account maintenance fees. Some brokerage accounts charge maintenance fees just for holding an account, especially if your balance falls below a certain threshold. Why it matters. Hidden fees can eat away at your returns without you even realizing it. Over time, these small costs can add up to significant losses. Solution: read the fine print. Before investing in any mutual fund or opening a brokerage account, carefully review the fee schedule to ensure there are no unnecessary or hidden fees. Always opt for no-load funds and accounts with no maintenance fees whenever possible. How fees and taxes affected two investors. Let's look at two investors to see how fees and taxes can affect their portfolios over time. Investor A invests in a mutual fund with a 1.5% expense ratio and makes frequent trades, incurring high trading fees and short-term capital gains taxes. Over 30 years, the combination of high fees and taxes significantly reduces their portfolio's growth. Investor B, on the other hand, invests in a low-cost index fund with a 0.1% expense ratio and holds their investments for the long term. They also maximize their contributions to a tax-advantaged account, allowing their investments to grow tax-free. Over the same 30-year period, Investor B's portfolio grows significantly larger because they kept more of their money working for them. By minimizing fees and taxes, Investor B was able to achieve much higher returns over time, showing the power of tax-efficient, low-cost investing. Key takeaways. Fees matter. High fees can significantly erode your returns over time. Choose low-cost investments like index funds and ETFs. Taxes reduce returns. Be mindful of how capital gains and dividends are taxed. Use tax-advantaged accounts whenever possible. Maximize tax-advantaged accounts. Contribute to IRAs, 401ks, Roth IRAs, and HSAs to reduce taxes and grow your wealth more efficiently. Use tax-efficient strategies. In taxable accounts, use tax loss harvesting and hold investments long-term to minimize your tax liability. Avoid hidden fees. Always review the fee structure of funds and accounts to avoid paying unnecessary costs. Keep more of what you earn. Transformative approach. Taxes and fees may seem like minor details, but they can have a major impact on your portfolio's growth. By understanding how these costs work and taking steps to minimize them, you'll keep more of your hard-earned money working for you. Remember, small savings on fees and taxes can add up to significant wealth over time. Take the time to review your investments, optimize your tax strategy, and choose low-cost options to ensure you're maximizing your portfolio's potential. With the right approach, you'll build a more efficient, tax-smart portfolio that accelerates your path to financial independence. Chapter 12. Taking action. Your path to financial independence. You've now learned the core principles of investing, understanding risk, managing taxes and fees, building a diversified portfolio, and using advanced strategies to grow your wealth. But knowledge alone won't bring you financial independence. The next step is the most important: taking action. This final chapter is about turning what you've learned into a practical, actionable plan. Whether you're just starting your investment journey or looking to optimize an existing portfolio, the key to financial independence is consistent, informed action. By the end of this chapter, you'll be ready to implement your investment strategy and take meaningful steps towards securing your financial future. Step 1. Define your financial independence goals. The first step in taking action is to clearly define what financial independence looks like for you. This will serve as your North Star, guiding all your investment decisions. Questions to ask yourself: what does financial independence mean to you? Is it retiring early, being able to travel, or having enough money to pursue your passions without worrying about income? What's your timeline? Do you want to reach financial independence in 10, 20, or 30 years? Your timeline will influence your investment strategy and risk tolerance. How much money will you need? Use a retirement calculator or speak with a financial advisor to estimate the amount you'll need to reach financial independence. This number will guide your savings and investment goals. Example: if your goal is to retire by age 55 and live on $60,000 a year, you might aim to save $1.5 million, assuming a 4% withdrawal rate in retirement. This goal becomes your target, and your investment strategy should be designed to help you achieve it. Tip: make sure your goals are SMART specific, measurable, achievable, relevant, and time-bound, as discussed in Chapter 5. This will keep you focused and motivated along the way. Step 2. Once you've defined your financial independence goals, it's time to build or review your investment plan. Your plan should include a clear strategy for reaching your goals based on your risk tolerance, time horizon, and financial situation. Key components of a solid investment plan. 1. Asset allocation. Decide how to divide your portfolio among different asset classes: stocks, bonds, real estate. Your asset allocation should reflect your risk tolerance and time horizon. Younger investors may choose a more aggressive allocation, 80% stocks, 20% bonds, while those nearing retirement may want a more conservative mix. 2. Ensure your portfolio is diversified across various sectors, industries, and asset classes. This will reduce risk and smooth out returns over time. 3. Tax-efficient accounts. Maximize contributions to tax-advantaged accounts like 401ks, IRAs, or Roth IRAs to reduce your tax burden and allow your investments to grow faster. 4. Make sure you have an emergency fund in place, typically 3 to 6 months of living expenses, to protect yourself from financial setbacks without having to dip into your investments. Tip: if you already have an investment plan in place, take this opportunity to review and update it. Make sure your asset allocation, risk tolerance, and goals still align with your current situation and long-term objectives. Step 3. One of the biggest mistakes people make is waiting for the perfect time to start investing, or believing they need a large sum of money to get started. The truth is, time in the market is more important than timing the market. Starting small but starting now is the best way to begin your journey toward financial independence. The earlier you start, the more time your investments have to compound and grow. Even small contributions can turn into significant amounts over time. Building good habits. Starting with small amounts helps you build the discipline of regular investing, which is key to long-term success. Example: If you invest just $100 a month starting at age 25 with an average return of 7%, you could have over $275,000 by age 65. Starting small still has a powerful impact. Automate your investments by setting up automatic contributions to your brokerage or retirement accounts. This ensures you're consistently investing, even when life gets busy or the market feels uncertain. Step 4. Stay consistent and avoid emotional decisions. Investing is a long-term game, and consistency is key. But as markets rise and fall, it's easy to let emotions, especially fear and greed, drive your decisions. This is where discipline and patience become your greatest assets. How to stay consistent. 1. Stick to your plan. Trust the investment plan you've built. Avoid reacting to short-term market fluctuations or trying to time the market. Remember, long-term success comes from staying the course. 2. Dollar cost averaging. Continue using dollar cost averaging to invest a fixed amount regularly, regardless of market conditions. This reduces the risk of buying high and ensures you're investing through both up and down markets. 3. As your investments grow, your asset allocation may shift. Rebalancing your portfolio once or twice a year ensures it stays aligned with your risk tolerance and goals. Tip: limit how often you check your portfolio. Constantly monitoring the market can lead to stress and emotional decisions. Instead, review your investments quarterly or semi-annually. Step 5. Monitor your progress and adjust as needed. Achieving financial independence requires regular monitoring and adjustments. While it's important not to make rash decisions based on short-term market movements, it's equally important to ensure you're on track to meet your goals. How to monitor and adjust. 1. Regularly review your portfolio's performance and compare it to your long-term goals. Are you saving enough? Are your investments growing as expected? 2. Adjust your contributions. If you receive a raise or bonus, consider increasing your contributions to your investment accounts. Boosting your savings during high-earning periods can accelerate your progress. 3. As life circumstances change, whether it's a new job, a major life event, or a shift in financial priorities, review your goals and adjust your strategy accordingly. Tip: use financial planning software or work with a financial advisor to help you stay on track. They can provide insights into your progress and suggest adjustments based on your evolving needs. The power of small, consistent steps. Let's consider an example of someone who followed these steps to reach financial independence. Meet Jane, who started investing at age 30 with a simple plan: invest $300 a month in a diversified portfolio of index funds. Over time, Jane steadily increased her contributions as her income grew. She took advantage of her 401k at work, contributed to a Roth IRA, and reinvested dividends. Throughout her journey, Jane stayed consistent, even during market downturns. She avoided making emotional decisions, stuck to her plan, and regularly rebalanced her portfolio. By her early 50s, Jane was on track to retire early, having built a sizable portfolio that could support her lifestyle for the long term. Jane's story demonstrates the power of consistency and patience. By taking small, steady steps, she was able to achieve financial independence without trying to chase market trends or time her investments perfectly. Define your goals. Start by clearly defining what financial independence means to you and set a smart plan for achieving it. Ensure your investment plan reflects your goals, risk tolerance, and time horizon. Start small, but start now. Time in the market matters more than timing the market, so start investing, even if it's with small amounts. Stay consistent. Stick to your plan, avoid emotional decisions, and keep investing regularly. Regularly track your progress and make adjustments as needed to stay on course toward financial independence. The journey begins now. Reaching financial independence is a journey, not a destination. The steps you've learned throughout this book will help guide you toward building wealth, but the most important thing you can do is take action. Start today, even if the steps seem small. Over time, these small steps will compound into significant progress, bringing you closer to the financial freedom you've always dreamed of. You have the tools, knowledge, and strategies to succeed. Now it's up to you to apply them consistently and stay committed to your goals. Financial independence is within reach, you just have to take that first step. The journey begins now. Final words. Your journey to financial independence. Congratulations on taking the first steps toward financial independence. By understanding the principles of investing, managing risk, and staying consistent, you've set yourself on a path that can lead to greater financial freedom and security. Remember, the key to success isn't perfection, it's progress. Whether you're just starting or refining your strategy, every step you take brings you closer to your goals. Financial independence is a long-term journey, but with patience, discipline, and the right plan, you'll get there. Keep learning, stay focused on your goals, and trust in the process. Your future is in your hands. Now it's time to take action and watch your financial dreams become reality. Here's to your continued success. Take care and be well.